What are the tax implications of long straddle hedging? Have you ever wondered how your investment strategies can impact your taxes? Today, we are going to break down the tax implications of long straddle hedging. This strategy involves holding both a call option and a put option on the same underlying asset, aiming to profit from significant price movements in either direction while managing risk. But how does this affect your tax situation? First, let's talk about the straddle rules. When you use a long straddle, the Internal Revenue Service treats these as offsetting positions. This means that gains and losses are not recognized independently. Instead, they fall under special straddle rules outlined in Section 1092 of the Tax Code. This classification can affect how you report your gains and losses. One of the key implications is the deferral of loss recognition. If you have a loss on one leg of the straddle, like the put option, you cannot recognize that loss until you close the offsetting position, which is the call option. This means you might have to wait to report your losses, which can complicate your tax reporting. Next, let's discuss how gains and losses are matched. The tax rules aim to align the timing of gains and losses on the two positions. When you close the straddle, you will recognize both gains and losses together. This ensures that the overall result from your hedging strategy is reported in the correct tax year. Now, what about capital gains? Gains and losses from options in a long straddle are generally treated as capital gains or losses. However, since options are often held for a short time, most of these gains and losses are considered short-term. Short-term capital gains are taxed at ordinary income rates, which can be higher than long-term rates. Additionally, there are limits on how much of your net straddle gains can be treated as long-term capital gains, with only 50% qualifying for that lower rate. Another important aspect to consider is the constructive sale rules. If your hedge completely eliminates the risk of loss and the opportunity for gain on the underlying asset, the Internal Revenue Service may treat it as a constructive sale. This means you could be considered to have sold the asset for tax purposes, which would trigger the recognition of any unrealized gains, even if you haven't actually sold anything. For traders using long straddle hedging, keeping detailed records is essential. You need to track each leg of the straddle carefully and identify these positions for tax reporting. If you fail to do this, you might face unfavorable tax treatment, such as disallowed losses or unexpected gain recognition. In summary, the tax implications of long straddle hedging include deferring loss recognition, matching gains and losses, limitations on long-term capital gains treatment, and potential constructive sale treatment. Understanding these rules is vital for traders to manage their tax outcomes effectively.